Top of the day and welcome to the Constructive House channel. I'm LT Fulton, your host and your mortgage advisor, and this is the daily mortgage briefing. And each morning I like to set aside some time to break down what's going on in the market, how it affects real home buyers, and how you can use strategy, not stress, to get mortgage ready. So each morning, I do like to set aside some time, but before we get into it and get your day empowered and informed, do me a favor, hit the like button, subscribe to the channel, and share this. Don't keep me a secret. Share this with your family and friends and anyone that you know that is looking to generate generational wealth. Because the key to generational wealth for most Americans is going to be home ownership. I know everyone talks about stocks and crypto and all of that, and that's great. Here, I'm a mortgage expert, mortgage advisor, and I'm going to tell you, most Americans are going to generate that generational wealth, that generational income through home ownership. It's about home ownership, owning something, about equity status, about equity stake. So without further ado, let's go ahead and get you informed and empowered. Put on your thinking caps and let's get constructive. And as we always do, first we want to kick it off with the mortgage snapshot, your market snapshot of the day. That way you can know where things are at, and that way you understand the importance of having a solid IPAC, because income, property, assets, and credit is what all lenders use to determine your ability to repay the mortgage. And today's market snapshot, most lenders are offering interest rates around 6.3%. That's what the market closed on yesterday. As you know, that's dependent on your credit, down payment, and loan type. Lenders will reprice throughout the day, depending on what's going on with the market movers, which is the bond market, inflation, the Fed, and housing inventory. That's going to determine if rates are going up, down, or remaining stable. So keep that in mind. Like I said, on a 30-year fixed conventional, rates are coming in around 6.3% for most lenders. Your particular IPAC profile is going to determine what interest rate you'll get for your credit profile. But as far as national average, we're coming in at 6.3%. As far as the bond market, which is one of the market movers, the bond market is reacting to mixed economic data. And when the bonds get cheaper, rates usually go up. So keep that in mind. Like I always break down with you all, the bond market is driven by MBS, mortgage-backed securities. And when the investors of mortgage-backed securities like what they see in the different boxes, think of the mortgage-backed securities as mortgages in a box, just like shoes or any other product you'd have in a box. If they like what they see in the box, then rates are going to go down. If they don't like what they see in the box, rates are going to go up. That's how mortgage-backed securities work. That's what drives the bond market. And today, the bond market is reacting to mixed economic data. So that means for you, when bonds get cheaper, rates will go up. So that's kind of where we're at with interest rates as it pertains to the bond market. Now, when we're breaking down inflation, inflation came in slightly hotter than expected, and higher inflation is going to mean rates going up. So whenever the Fed sees that inflation is going up, that it means the economy's doing well, and that means mortgage rates will go up. If the economy's doing well, then rates go up. And one indicator if the economy's doing well is inflation. So if inflation goes up, that is an indicator that the economy's doing well. I know a lot of you all like, hey, LT, I'm struggling to make ends meet. But the way that the Federal Reserve looks at it is if inflation is high, which means consumption for all your everyday products, your cosmetics, your food, groceries, gas, all your everyday expenditures. If the prices on those are higher, then that's what inflation means. And for the Fed, that means that people are doing so good, we got to raise the prices on their everyday consumption. So that also means interest rates are going up. So that's why they came in slightly higher. Again, this is based on yesterday's closing. The rates will reprice throughout the day, so don't hold me directly to it, but that's what we're looking at as we're opening up today's market. So that's where things are with inflation. As far as the Federal Reserve, the Fed, The Fed said they're staying cautious about cutting rates this week, and their comments always affect lender pricing. Keep that in mind. Lenders hold on to every word the Fed says. That's going to be the biggest indicator of all the market movers, the bond market, inflation, housing inventory. What the Fed says makes everything go. And right now, the Fed is still staying cautious. They're still monitoring closely what they're going to do based on inflation. So keep that in mind. But they're being real cautious about cutting rates this week. I know at the end of the year, we saw a dip down in rates that we haven't seen the entire year of 2025. But right now, things are ticking up slightly, not a whole lot, but 6.3 is higher than the 6.15 it came in at the end of the year. Now, as far as housing inventory, it's showing gradual seasonal normalizing trends. Like I've explained to you all before, this time of the year, it's not, there's going to be a higher inventory of housing this time of year because not a lot of people are moving in January, December, February. This time of year, you're not going to see a ton of movement there. Of course, people are always buying and selling. But right now, it's still showing that normal seasonal trend where it's not as much buying and selling as it is in the summertime. Because, when it's summertime, a lot of folks do love buying and selling. So that's what we have for the mortgage snapshot. So I hope that you do find that helpful. But the market movers, as always, the bond market, inflation, the Federal Reserve, and housing inventory are the market movers when we're talking about interest rates going up or interest rates going down. So keep that in mind. Now, as for today, of course, I always like to let you know what the word of the day is going to be or the phrase of the day. And today's phrase of the day is going to be PITI payment. And not pity like, I show pity on you, but principal, interest, taxes, and insurance payment. All right, so PITI payment is your entire mortgage payment. So principal is going to be the amount of money you actually borrow. All right, that's the amount you borrow, and it's broken down over 30 years if you're doing a 30-year fix. It'll be broken down over 20 or 15 years if you're doing a 15-year fix. But that's the amount that you actually borrowed to buy the home. And if you're refinancing it, you're still borrowing that to refinance your mortgage. All right, interest, that's the fee you pay the bank for letting you borrow that money. All right, that's what interest is. So that's the fee that the bank charges you for borrowing said money. Whenever you go get a house, if the house is $500,000, all right, if you don't have $500,000 in the bank, you're going to go get a mortgage to be able to get the $500,000 to buy the house. All right, so the $500,000 is the principal amount. Then you got the interest, which is the fee the bank charges you for allowing you to borrow that money. All right, that's going to be included in your monthly pay down, principal and interest. Now, if you're like most Americans out here, you'll also be including taxes in your mortgage monthly payment. And taxes are the monthly amount of your property taxes. All right, so that's going to be the property taxes based on the area you live in. They're going to break down however much it is due on the year or if it's every 6 months. However, they're going to break that down into a monthly amount and include that in your payment. That's the taxes. That's your property taxes, a fee that you have to pay for owning property. In this case, it would be home property, real estate property. Then you got insurance, which is a requirement when you have a mortgage, is an insurance payment. That covers anything that may happen from fire, flood, you name it, a tree falls on your house. You have homeowners insurance to protect you for any of those incidents that may come up. All right, that'll be breaking down in your monthly payment over a yearly term, annual term, and they'll put it in monthly increments. That's what makes up your PITI payment, P-I-T-I, PITI payment. That's principal, interest, taxes, and insurance. That's your PITI payment. All right, and the taxes and insurance are set aside in an escrow account and paid out when it's due, but they break it down with your mortgage payment to ensure you're not late on your property taxes or your insurance, and you'll make that full payment to the bank. All right, so I hope that helps explain PITI payment, but we will be breaking it down what's going on as far as payments, and how you will be an informed consumer. Informed consumer. And if you want to know where you stand on all of this, you need to go ahead and go to theconstructivehouse.com right here and get your IPAC score, because that breaks down your income, property, assets, and credit, which are the 4 pillars that every lender uses to determine your mortgage eligibility. When they send your file into underwriting, the underwriters are looking at your income, property, assets, and credit. They're breaking that down to see if you have the ability to repay the loan over a 30-year period, 15-year period, 20-year period, whichever loan you're choosing. So get your IPAC score, which is a mortgage readiness tool, and that will help you determine if you're mortgage ready. So you'll find out, hey, I got some work to do, or hey, I'm where I need to be. But it's free to get. So go on theconstructivehouse.com, fill out the questionnaire, get your mortgage readiness tool, find out what your IPAC score is. Myself and my team will help guide you through getting you prepared or getting you pre-approved if that's the other alternative. If you're looking at doing a refinance or a home equity loan, we can help you out with that. Me and my licensed professionals will assist you. It's not a pre-approval. It's not a underwriting approval. It's a readiness tool to determine if you are ready to move forward with that next step. It's called the IPAC score. You can go on theconstructivehouse.com to fill out the questionnaire and see if you're ready to kick things off in 2026 with some home ownership. All right. So as we move on to just what exactly a PITI payment means for you as a consumer and why it's important. The reason it's important is I've had people come to me, clients that I've dealt with, and they're like, hey, I need to get a lower mortgage payment. And then once I go through their IPAC and I take a look to see where they're at and how we can help get them a lower payment, sometimes what I find out is we're unable to get them a lower payment. And some clients think that it's because of the interest rate. Most of them think it's because of their credit score. But what I've found out is a lot of times it's because the property taxes went up in their area. And that has nothing to do with the lender. The bank can't do anything about that. Or your homeowner's insurance went up in your area because now you have to get flood insurance, which wasn't something that was required before, but now you've been flagged as a flood zone. So now you got to get flood insurance. And that's not anything a lender can do to lower your payment. We can't lower your insurance. We can't lower your taxes. So understanding that that part cannot be touched is important for anybody who's in the market for refinancing or purchasing a new home. Whenever you're seeing on Bankrate or any Lending Tree or Investopedia, whenever you're seeing these mortgage calculators, they can't guarantee what your property taxes and homeowners insurance will be throughout the duration of your mortgage. The only thing that'll be locked in is that principal and interest payment. If taxes and insurance go up or down, then that has nothing to do with the lender. Although it's included in your payment, it has nothing to do with the lender. So stay on top of that. And sometimes a lower interest rate by a point or a half a point may still not do much as far as your taxes and insurance if they've jumped through the roof over a year or two period. So keep that in mind. Keep that in mind. And that's why having a strong IPAC is of importance to you. Because whenever these things do happen, if your IPAC is strong, then you'll be in a position where you may still be able to take advantage of lower rates. You may still be in a position to take advantage of maybe a home equity loan where you can pay off some other debt to get yourself some breathing room on the mortgage payment. That's why making sure you have a strong income, property, asset, and credit profile is going to be particularly important for you. So the next thing I wanted to break down to kind of personalize or make things more relative is just a quick math example on mortgage payments, because I want to make sure it is very clear and easy to understand what's going down when lenders are breaking down your mortgage payment and why things that you see on Lending Tree or Bankrate aren't always what you see when you're speaking with a mortgage loan officer or a mortgage broker, why the payments don't look exactly the same. And there's a few reasons behind that. Sometimes payments don't look the same because your IPAC came in different. You know, your debt to income's higher than what bank rate is estimating. Your credit utilization is higher. You know, all these things play a role into what your closing costs will be. And closing costs is going to play a role in what your principal amount borrowed is. So that's going to change your payment. All right, a 6.3% may only cost one person $8,000, and it may cost you $9,800, based on your credit utilization, your credit patterns, your income patterns, the amount that you're putting down, the amount of reserves you have. That can all change what your cost for that interest rate is versus someone else's, or versus what you saw on Bankrate or LendingTree or lowermybills.com or on any other site that's giving you an estimate on your mortgage payment. Once you get down to the nitty gritty of your IPAC, you may find out that your particular payment is different. So I just want to give a quick math example so you can see why your payment may be different and you can be an informed consumer. Because again, this is how you build generational income, is off of home ownership. So you need to be equipped with the tools to build a constructive house. So just want to take a look here at a quick math example that I put together. And we're going to use buyer A and buyer B as the two examples. But two buyers both get a 6.5% interest rate on their mortgage. All right, on buyer A, their taxes are $300 a month. Their insurance is $150 a month. They don't have any homeowners association fee. And their total payment is $2,300 per month on a 6.5% interest rate. Now, we got buyer B. Their taxes are $500 a month. Their insurance is $250 a month. And they have an HOA, homeowners association fee, of $200 a month. Their total payment is $2,900 a month. And I'm sure we can see what the obvious reason for a difference in payment is, right? Right? I'm sure we can see that. All right. So the obvious difference, of course, is the homeowners association fee. It's the homeowners association fee. It's $200 more a month. But I know a lot of folks are like, well, hold on. I mean, I see that, but why is it $2,900 a month versus $2,300 a month? Well, the taxes are slightly higher for buyer B, and the insurance is slightly higher for buyer B. And I get folks all the time that are like, hey, man, cousin Jeff, he has the same interest rate as me, and we have the same loan amount. Why is my payment so much higher than his? And these can be some of the reasons why. All right, you're in a different county than cousin Jeff, and you have a different insurance company than cousin Jeff. And even if you have the same insurance company, you still may be having a different premium than them. Not to mention you have a homeowners association, and he may live somewhere where he doesn't have a homeowners association. All right, so you got the same rate, $600 difference, and that's why, because the rate didn't change. The payment did, which is the key takeaway. And the reason being is things beyond the lender's control. Okay? When you have taxes that are different, those are things that can be based on county to county. In some instances, zip code to zip code, property taxes can be different. You can be in the same county, but because of your zip code, property taxes could be different. Insurance can for sure be different depending on who your company is, depending on what your coverage is. So it's not going to always be a exact identical payment just because you have identical loan amounts and identical interest rates. So keep that in mind, because a lot of folks trip over that, they slip over that, or they think it should be fairly close. But as you see in this example with the same interest rate, and of course we're estimating the same loan amount, there is a $600 difference there. We're talking about a $600 difference every month. Now you think about that over a year. That's $7,200. That's $7,200 over the year. Now you do that times 30 years, and we're talking about $216,000 more that they're paying with the same interest rate, same loan amount. $216,000 more over a 30-year time frame. And it had nothing to do with the lender. It was about the HOA fee, taxes, and insurance being different. So always keep that in mind, that the PITI payment, principal, interest, taxes, and insurance, is going to be a key indicator on where your money's going. Stay on top of that. Make sure every month you're looking at that mortgage statement. Even if you got it coming out automatically to pay the bill, you still want to be looking at that statement. And I know some of you, oh, I don't get a statement. It's all online. That's still a statement. It's a digital statement, all right? You need to be looking at that every month. You need to be staying on top of that. Stay on top of what your annual property taxes are. If it's semi-annual, however it's broken down, stay on top of that. And make sure that the lender is calculating that appropriately. And they're not just sending in money, or they're not collecting enough. Because you could be like, oh, well, hey, it's low, so I like it because it's coming in lower, but they're not collecting enough. Guess what's going to happen? That PITI payment's going up next year, or the next time they pay it out. When they find out they're short, they're going to raise it. So stay on top of that. You're not getting away with anything. You're only putting yourself in a worse position. That's why having reserves is very important. That's why you got to get that IPAC score. You got to get that IPAC score so you can see where you're at. You can see if your mortgage ready. You need to make sure that you are bulletproof from these indicators over here. Every last one of them. All right? But keep that in mind when we're talking about PITI payment, because that's what we're focused on today. That's what we're focused on today. You need to make sure that you understand principal, interest, taxes, and insurance. Now, if you're someone who doesn't have an escrow account and you're making your payments separately, you still need to be putting yourself in a position where you understand PITI payment, because you need to evaluate if maybe it's better for you to utilize having an escrow with your bank account or with your mortgage company, or if you still need to stay where you're at. But breaking this down in monthly increments, even if you pay it on your own, would be of importance, and something that would be particularly smart and wise on your end, just to ensure that you're always on time with it. Because I know some folks who don't include their taxes and insurance in their mortgage payment. Now, I will say, if you're getting a government loan, you don't have a choice in the matter. VA, you got to have a taxes and insurance included with your payment. FHA, USDA, you have to include your taxes and insurance with your mortgage payment. You have to make a PITI payment every month. It's not a choice. It's not an option. All right, so that brings us to the IPAC Spotlight of the day. As I'm sure you could have guessed it already, it's going to be payment. All right, and we're talking about mortgage payment. And your payment includes principal, interest, taxes, insurance, and sometimes homeowners association fees. Now, mortgage insurance, if you have less than 20% on all loans except a VA loan, you'll be paying mortgage insurance each month. That will also be included in your mortgage payment. So if you have less than 20% down, I know some of you guys want to roll with the FHA 3.5% or the conventional 3% down payment when you're buying a house, or even down payment assistance with a zero down. Those are all great opportunities to get into a house with putting little to no money down. However, the lenders do charge a fee called mortgage insurance each month. And that insurance is not for you. That's for the bank. That's for the lender to insure them in case you have to be foreclosed on. That's their insurance policy. And because they're allowing you to put down less than 20%, they will charge you a fee, and you're going to pay their insurance. You're going to pay their insurance. You're paying the insurance for the lender, for the bank, because you don't have 20% to put down. They look at you as risky. And whenever you're risky, we go back to the bond market up here. When you're risky, investors can be scared to buy that mortgage, because mortgages are like products. Investors can be scared to buy that mortgage off of the bond market, which is what all banks and lenders want. They want investors to buy their mortgages that they're quote unquote selling on the bond market. So if you don't have 20% down, you can be scary to some buyer, to some investors. And if an investor knows, hey, on this particular FHA product, they're required to pay insurance in case they in case they default on the loan. So that makes them a little more comfortable with investing in your mortgage because they know there's an insurance policy on there. But the bank's not paying that insurance policy. You are. And that's what mortgage insurance is. They're going to make sure you pay insurance in case you default on the loan. They're covered insurance wise. So that will also be included in your mortgage payment. So keep that in mind when we're talking about PITI payment. If you have less than 20% down, you'll be making a mortgage insurance payment too in that insurance category. Not just homeowners insurance, it'll also be mortgage insurance. But that is not an insurance that protects you, that protects the bank. So keep that in mind. That's why it's always important if you have a lender calling saying they can lower your interest rate and you know you're in a position where you're also paying mortgage insurance, always make sure you exhaust your options to pay as little fee to the bank as possible. Because the way I sell it is mortgage insurance is just another category of interest because it's a fee that's going to the bank. It's not going to any type of equity in your home. You're not going to gain any ground on your principal. It's a donation. You're making a donation to the bank. But I do want to keep that in mind because if you have two clients, two buyers with the same rate, the same loan amount, they can still have different payments. Just like the math example we went over earlier, and just like what we're talking about here, where one buyer may have put down 20% and that's why y'all have the same loan amount and you didn't. Like that can happen as well. They put down 20% and you have the same loan amount because they may have bought a house that was $600,000, but they put 20% down. You may have bought a house at the same interest rate. I mean, at the same loan amount, but you put less down. Y'all got the same interest rate, and you're trying to figure out, well, how come my uncle's payment is lower than mine? Well, your uncle put 20% down. Yeah, y'all got the same loan amount, but what you aren't factoring in is their down payment was stronger, so they were viewed by underwriting by the lender as a safer, a less risky buyer because they had the reserves, they had the down payment. They had a strong IPAC and yours was not as strong. So yeah, you have the same loan amount. Yeah, you have the same interest rate, but you do not have the same payment. And that's how it works. It's very nuanced. The truth is stranger than fiction. All right, so just breaking that down because I just want to ensure that folks are familiar with why you can have different rates. I mean, different payments. Excuse me here. It's very important that you understand the market movers and your IPAC because that's going to determine what your payment's going to be. I've seen it too many times. Buyers having somewhat similar loans, but their IPAC profile is very different. Their debt to income ratio is 38%. Someone else's is 55%. The one with the 55% is going to look more risky to the bank. They're going to be scarier when the investors in the bond market are looking at the different mortgage products, different profiles, and they're like, this one's a little scarier. Banks already know this up front. Lenders know this up front when they're underwriting. So they're going to do their due diligence when it comes down to your pricing, the cost, because it's going to be harder for them to get an investor in that mortgage product. So they're going to ensure that they're going to make sure you're paying some fees because it's going to be harder to get your mortgage product off the shelf. It's going to be harder to get you bought out the box because that's how lenders make their money. That's how they truly make their money. It's going to be based on how good the mortgages look. They're making their money off of the investors in the bond market. That's how banks and lenders are making their money. Yeah, interest plays a role, but they're true money that allows them to lend to more Americans, that allows them to keep lending and keep pushing out loans every day like they do is based on the investors in the bond market being able to sell those mortgage loans on the bond market. That's how they're really making that money, getting investors to keep pouring money into the bond market for FHA 30-year fix, for conventional 30-year fix, Fannie, Freddie, VA, USDA. The more investors they have, the more money a bank has to lend out to other folks. That's where they're going to get all of it. They can't wait for every person to pay 30 years of interest. They can't do that. So the investors who are pouring money into different mortgage products, that's how the banks make their money to keep lending. So that's why these market movers are so important. That's why understanding your IPAC is important. And that's why this daily mortgage briefing is important. So please hit that like button. Please subscribe. Do not keep me a secret. Share this with a family, friend, colleague, co-worker, whomever you come across. Because generational income is built off of home ownership. Keep that in mind. So a couple of do's and don'ts. We'll go over some action steps for you here, and then I'll let you on your way. But when we're talking about payment, you need to do this. You need to focus on your monthly affordability. Look at what it is that you can take on capacity-wise, what you can afford, because that's going to be a tell-all sign of where your debt to income is. But look at your monthly affordability. After you're paying your bills every month, look at what you have left over. And see what you can take on. See if you have opportunities for investment. See if you can take on buying a home. But look at your monthly affordability. What I don't want you all to do is obsess over the interest rate. I know I break down in the market snapshot what interest rates are, but do not obsess over it. Interest rates are to be used as a tool of guidance. It's just a guideline to see where you are. But you don't want to obsess with interest rates over payment, because you make your payment in dollars and cents. You don't make your payment in percentage. You don't write a check. You don't put in you put in your debit card when you go online and make a payment. You don't go in there and say 5% interest. No, you're putting in a exact dollar and cent number. That's what you're putting in. So keep that in mind. Do not obsess over interest rate, because you can have the same rate as someone else and have a different payment than them. As I showed in the math example, a $7,200 difference every year, and they have the same interest rate. But folks will be so focused on interest rate that they're not even paying attention that you're paying $7,000 more than them and you have the same rate. So obsessing over interest rates is not where you need to be at. You need to be determining, hey, am I in an area where the homeowners association fee is $200 a month, and can I get another house where it's zero? Am I in an area where the property taxes are $150 more a month? Where I'm in a flood zone, so the homeowner's insurance is $200 a month. My mortgage insurance is $95 a month. Like, all of those make a particularly key difference in what your payment is. Because what's going out the door every month is what's most important. The next step is making sure the bank gets as little of what's going out the door as possible. But when you got property insurance through the roof, when you got homeowners insurance that's high, when you got HOA that's high, and you're paying mortgage insurance, and all you're worried about is the interest rate, look at these other fees that have nothing to do with interest rate that you're paying every month, thrown in the toilet because you moved on the other side of the freeway. These are things you got to pay attention to. These are things you need to be asking your real estate agent. These are things you need to be checking with your mortgage advisor. Because obsessing over an interest rate is not something that is going to help you. All right? You don't want to just obsess over an interest rate. Yeah, you want to pay the bank as little fee as possible. But when we're talking about taxes, homeowners insurance, mortgage insurance, the other factors that go into your PITI payment, interest is one of those four that we discussed. Just one. What about the other three that have nothing to do with interest? Nothing to do with interest. And you'll be making a higher payment because you're just focused on the interest. I don't know how many times I have spoken with clients who they're so obsessed with the interest rate that they end up paying points. They end up paying, they move into a place where, because I told them a low interest rate, they're going to move somewhere that has a high HOA fee, ridiculous HOA. And usually in those areas, the property taxes are asinine. Then they end up going. They end up all those types of people, because they're all the same. They end up having a homeowner's insurance policy that has all kind of stuff in it that they don't even need, and they end up paying $7,200 more a month than someone with a pretty identical mortgage profile, same loan amount, same interest rate, but they're paying $7,000 more a month. But they're so focused on the interest rate because in their mind, a lower rate means lower payment. But as we see, that rate could actually mean a higher payment. That's why income, property, assets, and credit are so important. So important. So what I want you all to do today, what I want you all to do today is break your payment into parts and see what you can control. Look at what your monthly insurance is. That's something you can control. You can shop around for better insurance, better homeowners insurance. Look and see as far as property taxes, if that's correct. You know, sometimes lenders will collect more than what's needed. Sometimes they're collecting less than what's needed. And in your mind, oh man, well, hey, if it's low, I'm not going to bother them. You'll end up paying more. So go ahead and correct that while you have the opportunity. Get that straightened out. See what you can control. You can't control principal and interest. Now, as far as interest, you can control that with a refinance. You know, and from there, you got to do your due diligence. Make sure the loan amount isn't jumping up to where the payment's not going to, you know, make a much difference for you. But look at what you can control. You can pull out your mortgage statement. Look at principal, interest, taxes, and insurance. Look at what you can control. All right. Break your payment down. Make sure it all adds up. Make sure it's going to pay off what's coming due for your homeowner's insurance and for your property taxes. Make sure your amortization is on schedule. This is your investment. Home ownership is your investment. It's your gateway to generational wealth. So stay on top of it. If you want to know how your IPAC stacks up today, take the free IPAC score at theconstructivehouse.com. I do appreciate you all for staying tuned with me on the Daily Mortgage Briefing. Remember, you don't need perfect circumstances to buy a home. You need a strong IPAC strategy and the right information. If you want help reviewing your IPAC score or planning your approval, the links are in the description. I hope you all do have a constructive day. Thanks again for tuning in. Don't forget